Hello, my name is Joseph Beige. I'm a real estate attorney on Long Island, and I want to welcome you to our show. My goal is to provide you, the Long Island real estate consumer, with insight and information to help you make a more informed decision on your next real estate transaction. My hope is the information presented here will not only help you make better, more informed decisions, but that you will understand and be more comfortable with the real estate transaction process. More comfort means less stress, and everybody can use less stress. Now, regardless of whether we're talking about first-time home buyers, seasoned real estate investors, whether it's residential or commercial, everybody who's purchasing real estate has one common starting point. Before they look at property, before they determine what they want to buy, they have to determine how they're going to pay for it. And for the vast majority of people, how they pay for it will be with a loan. And that will bring us to our guest today. If you're in the market for a new home or refinancing a current one, you're going to have to go to a loan specialist. And I have today with us Peter Browning of East Coast Capital, who represents East Coast Capital, who is a mortgage banker. Thanks for joining us, Peter.
Joe, thanks for having me on your program.
Peter, before we get into a little more questions of what I have about the loan industry, let's give a little background about yourself, because you've been in this industry a very long time, good times and bad, correct?
That is correct. I've been in the mortgage industry for now 26 years. All aspects of the mortgage industry, from sales to processing to underwriting to running a company, working for a very large firm, and then stepping back and helping consumers and first-time home buyers and real estate investors get to the ultimate goal right now with the least amount of issues through the process.
Excellent. And, one of the things, especially when it comes to real estate, I've been doing this for about 30 years. And again, I've gone through the good times and the bad times. I'm impressed by people who have longevity in the industry, and especially on the mortgage side, because you went through probably the worst period in the mortgage industry, which is when there were no mortgages. And that gives a unique perspective, I think.
Yeah, that the whole housing bubble really put a damper on the mortgage industry. But it also helped it as well, too, because right now in the time, the housing industry has flourished back. It's grown. There is a housing shortage. The housing is in high demand. And for people that are looking to purchase homes, the realtors are really looking for qualified borrowers. So they know that once they go and put an offer in on a house, they know that it's a true offer and that it will go through.
Yeah, that's very important. I know when I represent my sellers, that's how when we evaluate offers, it's always we're looking for qualified buyers who've been qualified, and then the quality of that qualification that they got, which is excellent. I mean, I started back in real estate in '91 as a real estate agent before law school. Back then, we pre-qualified a buyer by basically saying, what's your income? We doubled their income, and that's what the mortgage amount that they could qualify for. It's come a long way since then.
Absolutely, it has.
Actually, before we move on to another subject, since we brought up qualified purchases, what is something that you would do or East Coast does in order to pre-qualify a purchaser?
Great question. As you said, back in the past, it would be, well, you have a job, you have a loan. Now that time has really changed, and what we look for in a borrower is we're looking at your income. We're looking at the assets that you have to put down on the house or contribute to the transaction. We're looking at your credit. And, there are several qualifying aspects, depending on the type of program that you're doing, that you would need to qualify for. So we're looking at your income for debt to income ratio, how much you could actually afford versus what you'll be paying out. Also including your current liabilities that you're paying on a monthly basis. We're looking at how much money that you have to put down. And then we're looking at ultimately your credit score that's given to us from 3 bureaus. That's TransUnion, Equifax, and Experian.
Excellent. So it's almost like an application, only a mini version, or application light.
Correct. So when we're doing the qualification, a borrower might know a neighborhood that they're looking to purchase in. So we'll have a rough estimate of what the taxes will be. We could kind of guess what the homeowner's insurance would be on the house. And it's really up to them to tell us what they're looking to, their purchase price, their purchase point.
Excellent, excellent. Now, we went off topic almost immediately, so I apologize to viewers on that. Now, like we said, East Coast Capital is a mortgage banker. And for people who are unfamiliar with real estate and the loan industry, they don't necessarily understand that there's a difference between retail banks, mortgage bankers, mortgage brokers, and so forth. Can you just explain in substance what a mortgage banker is?
Sure. A mortgage banker is a lender that's actually lending their money. Okay. They will write the loan to industry standards, whether it's from Fannie Mae, Freddie Mac, or FHA, VA. And then they'll lend their money. Whereas a mortgage broker will actually shop your loan around to different lenders. Okay, so a borrower that applies to a loan with a mortgage banker, they're dealing with one person, one lender, whereas if they go to a mortgage broker, they're going to have their loan shopped around to several different lenders.
And as you got into a lot of the advantages right there, but just so people understand, the mortgage bankers, such as yourself, are licensed by New York State, correct?
Yes.
Okay.
Mortgage bankers are licensed by New York State. Mortgage brokers also have to be licensed by New York State as well, too.
Excellent, excellent. Now, you started to hit on the different types of loans, and I know people are amazed. Clients sometimes are amazed about the different types. They may hear some of them like FHA. They may have heard about VA. There are jumbos, conventional, all these different ones. Just can you give us a quick overview about what's available for a borrower?
Sure. There's, you have a conventional loan, which would be backed by Fannie Mae or Freddie Mac. Okay. And you could put as little as 3% down on those for first-time home buyers. Then you would have a FHA loan, which is more designed. It's designed for first-time home buyers or any borrower at that matter that might not have enough credit, or I might have derogatory credit in the past, such as bankruptcy or foreclosure or short sale. We could still qualify them. FHA is a little bit more lenient. And then you have the VA loans. Those are designed for our military, retired military, current military, where you don't have to put any money down. It's no money down. It's 100% financing for the military.
Excellent. Excellent. Now, you used two phrases in there, Fannie Mac and Fannie Mae. Just for the average person, they've heard these names thrown around, usually when it's something bad, going back to the financial crisis, in the mortgage industry. But what are they?
So Fannie Mae and Freddie Mac are two separate entities. Okay. Over the years, they were individual entities. And then during the housing crisis, they were now considered government-sponsored entities. Okay. They're backed by the federal government. They just look at, they have a little bit different underwriting parameters. Okay. For the regular consumer, it doesn't matter whether they get a Fannie Mae backed mortgage or a Freddie Mac backed mortgage. That's more for the mortgage lender to decide how they're going to securitize a mortgage on the back end of the market. So even though you might get a loan with ABC Mortgage Company, that doesn't mean you're going to be making your mortgage payments to ABC Mortgage Company. You might be able to make it to another servicing company. And those GSEs just swap notes around.
Excellent. Excellent. Of course, those are the securitizations of kind of where we had the problems back in the early 2000s.
Correct.
But they have made some changes, and the government has thankfully stepped in on that. Okay. Now, let's talk about first-time home buyers. There are a lot of them out there, a lot of people trying to get to that dream of home ownership. Obviously, the pricing and the current inventory, especially on Long Island, is daunting. And on top of that, now there's the loan process. And unfortunately, I think a lot of first-time home buyers don't have a lot of good information about what's available to them. If they did, they would see that there are more opportunities. So on that subject, what would you like to tell a first-time home buyer out there?
So first-time home buyers, there used to be a lot of government grants out for them. They're still available. You can get a grant from, your at a county level for it. Whether it's to help with down payment assistance, to help with your closing costs, and you would have to look into the local government through Suffolk County or Nassau County, or within the municipalities such as Town of Smithtown, Town of Huntington, Town of Babylon, to see what's available for them. Most of those grants have income restrictions. Okay, so you need to see if the first-time homebuyer would fall into that. If you don't fall into that, first-time homebuyers, depending on the type of program that you're going to qualify for or what you're going to apply for, you might be able to put as little as 3% down. Okay, 3% down, you could do that as a conventional loan. 3.5% down, you could do as an FHA, and no money down, you could do as a VA if you're a veteran. Okay, within that, there's other types of concessions that you could build into the loan itself, and you would obviously discuss that with your clients, what's called a seller's concession. So that seller's concession can also help offset closing costs if you can't qualify for a down payment assistance.
Great. And now we've been mostly talking about things from the buyer or the borrower's perspective, but on the seller's concession, I just want to take a moment to address sellers who may be watching this. A lot of my sellers come to me when they hear a deal's been presented to them with the seller's concession. And it's funny, they kind of look at me like, like one of those old movies where they're kind of like, the speakeasy, kind of going, doing a seller's concession. Like they think it's illegal, and I got to convince, no, it's not illegal. And can you just explain exactly what a seller's concession is?
So a seller's concession is a way to finance your closing costs into the loan, okay? Closing costs on a refinance could be financed into the loan, and they don't have to come out of pocket with closing costs. But when you're putting a purchase, when you're doing a purchase, you have to put your down payment money down and also have your money for closing. So a seller's concession, depending on the program that you're doing, you're allowed up to a 6% seller's concession on FHA with 3.5% down, 3% seller's concession on a conventional loan. Okay, so what you're doing is you're increasing the sales price of the house by 3%, okay, to help offset that. The seller agrees to give a concession of 3%, provided that the house appraised for above the agreed upon contract amount. And then they're giving that money back from the seller to the buyer to offset their closing costs.
Okay. So essentially the way I always like to explain it, and certainly correct me if I'm wrong, let's say you're selling a house for $100,000, or you're buying a house if you're a buyer, and you want to get a $3,000 seller concession at 3%. You now make the price of this house $103,000. You now, when you're taking a mortgage, let's say you're taking a mortgage for 80% of the sales price, now instead of getting 80% of $100,000, you're getting 80% of $103,000, and that extra money is what you're able to offset your closing costs with. Correct.
That is correct. You're going to still be financing 80% of the $103,000, and the 3%, the $3,000 will be used for your closing costs.
Excellent, excellent. Now, loan to value ratio, LTV, gets thrown around a lot. And before we get into some more details, like you talk about a 3% down, you talk about how the government essentially insures a loss to the lenders. First off, what is loan to value ratio for the average person?
Loan to value is what you're borrowing versus what your house is worth. So if you have you're buying a house for $300,000, okay, and your purchase price is $300,000 and you borrow $200,000, the difference is your loan to value, okay? So $300,000 is your value of your house. $200,000 is your loan amount. So you would take your $200,000 divided by your value of your house, and that would be your loan to value.
So you're better with math than me. So you used numbers. I would have done it on a simple. So let's say you're doing a $100,000 house. So for every $100,000, you're borrowing 80% or $80,000. Then your loan to value ratio would be
80%.
80%. Okay. Now, what's the magic number with the lender where things such as purchase, PMI or purchase money, mortgage insurance kicks in, and things of that nature?
So it varies upon each type of loan product you're doing. Okay. Right now with FHA, regardless of the loan to value, you're required to have mortgage insurance. Okay. Regardless on FHA, and that varies depend upon your how much you're putting down. There's two parts to the mortgage insurance premium with FHA. One is called an upfront mortgage insurance premium, and that's 1.75% of the purchase price. Then you have an annual. If you're at a 96% and a half financing, the annual is 0.85%. And if you're under 95% or under, then it's 0.80%. Okay, and that will be broken up into 12 monthly installments. That's for FHA. On a conventional loan, anything over 80% loan to value will require private mortgage insurance, PMI. Okay. On a VA loan, it's all going to depend upon the veteran status, if there's a funding fee or not. Okay.
Excellent. So now the shorthand is if you have 20% equity or more and you're going on a more conventional and non-FHA, then you can avoid PMI.
Correct.
Okay. Now the question I have for you, staying on that subject real briefly, if a borrower gets an FHA, okay, it's an excellent program. It's been around forever. It allows you to go with a minimum down payment because, certainly on Long Island, trying to save up 20% of a house value is almost impossible. Does that insurance, that PMI, does that stay with it for the life of the loan, or if there's a point where they reach the 20% equity on an FHA loan, that drops off?
So it used to be where FHA would drop off. Excuse me. Currently, right now, it's required for the life of loan. If you're doing a refinance on an FHA loan and you're at an 80 LTV, you would still be required, but it only lasts for 11 years.
Excellent. Excellent. Okay. Now let's just talk about something, because you talked about finance and refinance. And it seems like a lot of my clients, a lot of borrowers throw refinance and HELOC or home equities in as the same. They think they're the same, and they're not. They are two different types of loans.
Correct.
Okay. Briefly, can you just explain what the two differences are between the two?
So a refinance is you're taking your existing lien and you're paying it off, and you're going to get a new loan for a new set term at a new interest rate. Okay. A home equity line of credit, or also known as a HELOC, could take first position or second position, and a home equity line of credit is more like a credit card. Okay. So you're only going to pay interest on how much you owe on that line of credit, and you're only going to be able to have the home equity line of credit open for a certain amount of time before they close the line of credit, and then they require a repayment on it. The home equity line of credits, most of them are adjustable rate mortgages. There's very few that will have options where you could actually lock in a balance to that and pay it off at a certain time.
Okay, excellent. Now, on a refinance, you can still, we call it a cash-out finance, or you call it a cash-out finance. So now, can you just explain how that would work?
So, yeah, a refinance, there's a couple different things that you could do on a refinance. You could do what's called a rate and term, where you're just going to refinance your current balance and your interest rate maybe into a lower term or longer term to get a lower payment. Or you could do what's called a cash-out refinance, and you can get, cash in hand to actually pay off credit card bills, to get money to put into an annuity, finance children's college. The cash in hand's up to you to do what you want to do with it.
And as far as the interest rates between a refinance and a home equity line of credit or HELOC, how do they compare? As you said, I know the HELOC you said is generally a variable rate, or refinances obviously are more likely to be a set rate. So, having a HELOC versus a rate and term refinance, it's like comparing apples to oranges. Both have their benefits, both have their negatives. If you have someone that's been in a mortgage for 10, 15 years and they're going to refinance and go back into a 30-year mortgage and they only need $20,000, I would more likely instruct them to get a home equity line of credit than refinancing them, depending on what their interest rate is. They're both great products. It really depends upon the whole scenario, what the borrower is trying to accomplish. What we do is we'll sit down with them, we'll have a conversation with them, just a very light conversation, try to find out what their goals are, their financial goals, what their future goals are, if they plan on staying in the house, selling, if they're looking to buy an investment property in the future.
and then kind of come up with a game plan to see what makes sense for them, because ultimately every loan is different, every borrower is different, and their financial goals are different as too, and their circumstances are different.
That's an excellent point. Nowadays, especially with computers, a lot of people tend to shop, especially if they think they want a home equity or they think they want to refinance, they'll look at various banks, just going by the internet, and they'll skip over sitting down with a professional such as yourself and doing a consultation, which can be eye-opening, and they may find options that they never thought about. That's interesting. I'm glad you made that point. I want to get back to something we talked about earlier. And you said as a mortgage bank, one of the advantages that East Coast Capital brings is that everything is under one roof, processing, underwriting, and so forth. So let's talk about the processing a little bit. What exactly, when we talk about, when a borrower hears mortgage processing, they don't, most people don't know what it means. Can we tell them what to expect? What is processing?
Yeah, so there's a lot of back-end work that's done on a mortgage. We have to verify all the documentation that a borrower gives us. We need a lot of due diligence that has to be done on the loan, and ultimately we underwrite towards guidelines. Okay, so the process, once a borrower sits down with a loan officer, they'll put a formal application in. We'll send out a set of disclosures. We'll go over the disclosures with the borrower. They'll sign them, and then we get the loan into process. We'll ask for basic items, pay stubs, W-2s, photo ID, to get the whole process going. And it'll go into what we call processing. They'll verify the documentation and the information they gave us on the application. Then we'll submit it into underwriting, make sure it qualifies for the program that they're looking for. If it doesn't, we'll come back with a couple of conditions. Maybe we need something additional more, whether there might be a large deposit on a bank statement, maybe there's a gap of employment, and we'll put everything together. Once underwriting approves it, then it will go into, our closing department, and then we'll actually physically set up the closing.
Excellent. And let's talk, I know you briefly talked about the underwriter. What is the job of the underwriter in this whole process?
So the underwriter is, they're very versed in the guidelines with each individual product that we went over. And every product has different set of guidelines. So they have to know what each agency requires, and then when they review the borrower's application, they'll make sure that it fits that agency's guidelines. Okay.
Excellent. And typically, how long does the loan process take from the time somebody brings you an application to the time that it gets cleared by the underwriter?
Yeah, it's a great question. On a purchase transaction, it's much different than a refinance transaction. And the reason being is because on a purchase transaction, there's so many more people involved in it. You have attorneys, buyers and sellers attorneys. You have appraisers, because we have to get their house appraised.
Right.
You have, sellers that have to coordinate their moving and sell the house, and if they're buying another house contingent upon your house, and then just everyone's schedule. From what I've seen right now, on average, it's about 45 days from start to finish, provided that everyone cooperates. Okay. You'll have, someone going away on vacation. It might stall someone. You might have someone that has something planned where it stops. If the seller is selling the house and it's contingent upon buying another house, it could be a domino effect. So it could extend 60, 90 days. I have seen that. Okay. On a refinance, probably about 3 to 4 weeks.
Excellent. And when we talk refinance, time frame for home equity line of credit would be probably about the same?
Home equity line of credit is about the same, about 30 to 45 days.
Excellent. All right. I want to get into a couple of things now, and I want to pick your brain on behalf of borrowers, okay? Now, what is, you've been doing this again, you said how much, 20-something years?
26 years.
26 years, okay. Most people start to retire out of careers at that point. So, and you're going strong.
Still trying to decide what I want to do when I grow up.
Yeah, well, join that club. What is the single biggest mistake you see borrowers make?
There's a lot of things that borrowers do, unbeknownst to them. because they're not properly educated at the time of the application. The one thing that I could tell borrowers is that whether you sit with me or sit with any other loan officer or any other bank, you want to be truthful with them. You want to let them know if you're going to be changing jobs. You want to let them know if you need to buy a new vehicle. You want to kind of stay away from the big purchases. You buying a house is exciting, so you want to go out and you want to shop for furniture. Hold off on that. It's okay to go look, just don't purchase anything just yet.
So don't spend any money and be honest with the person that's going to help you get your loan.
Yes.
Okay. Now, question for you. When a borrower sits down with a loan officer, or when they're shopping for loan officers or shopping their loan, what are some of the questions that they should be asking of the loan officer?
That's a great question. Nowadays, since the whole housing crisis, the one thing that you want to do to make sure that the loan officer that you're dealing with, you want to make sure they're licensed. Okay. There is a national database to see if the loan officer you're dealing with is licensed. You could go onto it's consumeraccess.org, and you could type in the person's name. If they give you an NMLS number, you could type in their NMLS number and make sure that they're licensed. Okay.
Excellent.
The other thing too is there's two different types of licenses. Okay. One is a state chartered license, and the other one is a federally chartered license. I would recommend, if you're going to deal with anyone, you want to deal with someone that's state chartered. The reason being is the person that is a state chartered license, they actually had to physically go take a test and do education, and they have to do renewal education each year. Whereas a federally chartered license, the bank, the institution, whether it's a Chase, Citibank, or Wells, they're providing their education to their loan officers. Okay, so they might not have the years of experience where a state chartered person might have a little bit more experience based upon the education that they have to go through to get licensed.
Excellent. And in terms of closing fees or lender fees, what are some of the questions that a borrower should be asking?
Each lender is a little bit different. There is, could be origination fee or discount points, depending upon the transaction. You really want to look at that and have a conversation with your borrower. Standard industry fees, from what I see, is you might have an application fee and a processing fee and an underwriting fee. Most lenders, I haven't really seen any points being charged unless a borrower chooses to buy down an interest rate. In this market that we're currently in right now, I haven't seen that. Okay.
And it's interesting because that was very common 10, I got into this industry. It was actually, believe it or not, double-digit interest rates on mortgages, and people were happy it was only 10 or 12 or 13%.
Right.
And at that time, when you talked about points, people used to be able to, at the closing, pay a point, which is 1%, and buy down the interest rate and make it from a 10% to a 9% or what have you. Now, that kind of points is different than an origination fee, correct?
Correct. So, an origination fee could be based upon the type of loan that they're getting. I see it more common that, someone that doesn't have the credit standards that they need to qualify, they might charge an origination fee up front, knowing that they have to get a lower interest rate in the future. It also depends upon the product, because a lot of times what happens is in certain states and on certain programs, you can't charge a processing fee or an application fee. So you would have to charge an origination fee that would offset those fees that a bank would normally charge.
Excellent, excellent. Now, quick question. Now, how can a borrower make themselves more appealing to lenders?
That's a great question. I wish every borrower was this 700 plus credit score, has been on the job for 5 years, has 20% to put down. That doesn't happen. Everyone is looking to have the American dream of owning a home. So it doesn't really matter what your situation is. If you pay your bills on time, if you're able to save money and you have a job, some sort of job stability, that's what lenders are really looking for. Even if you're right out of college and you got you only been in the workforce for a year, that's great. Those are the borrowers that we want to help. We want to help people that want to be financially responsible to own a home and have their home.
Okay, so kind of a little bit of a loaded question, but credit cards. Should a borrower hold tight, speak to you first? Should they take it upon themselves to cancel out credit cards or apply for more credit cards?
Yeah. Credit cards are the good and the evil. They're good to have, provided that you're financially responsible to utilize them properly. Okay. Credit cards, I believe that everyone should have them. Your utilization of your credit cards to have the best credit score is to really keep the utilization at 50%. So if you have a $1,000 limit, keep the balance no higher than $500. Okay. If you have a charge card like an American Express, use it, pay it off. That helps build up your credit. I would not suggest opening new credit cards unless you speak to your loan officer and your score is low. Sometimes by opening up a credit card will actually increase your score. Okay. Closing your credit cards is probably the worst thing that you could do. Okay, because when you have a zero balance on a credit card and you have a limit of $1,000 and you close it, now you just shrunk your utilization of your credit profile. Okay, and that's actually going to hurt your credit score.
Gotcha. So in other words, when your example was use one credit card of $1,000 limit and a $500 balance, but let's say you had 3 credit cards that added up to $1,000. If you close one of them and had a $500 credit, now you're down to $500. Now you got to cut down your utilization to $250.
Correct.
Gotcha.
Correct.
Interesting. And some of it is a little counterintuitive. You would think closing out credit cards would help you, and getting a new credit card would hurt you. But as you just said, sometimes it can be exactly the opposite.
Absolutely.
Okay. All right. Just kind of staying on that, because I have had a few clients that have had this issue. They found themselves in over the head with credit cards, and they've gone to a debt consolidation service. And then we're kind of surprised to find that actually kind of hurt them down the road. From the loan industry standpoint, how do they look at debt consolidation issues?
Well, in the past, debt consolidation was looked at as like a Chapter 13 bankruptcy, where you're renegotiating your debt someone's renegotiating your debt to help you pay it down. I don't believe in going to these type of companies to help you, because I've seen them actually hurt the credit more than help them. A borrower can take it upon themselves to, put themselves on a budget and kind of knock it down. If they understand how the utilization works and they're at max limit, they might pay a minimum payment to one credit card this month, but pay more to another to help them bring that and work that together. The other thing too is, if they have had issues with the credit in the past, where maybe they paid it late or they have a collection or a judgment against them, they can call these companies and absolutely negotiate on behalf of themselves and tell them, listen, we want to help, we want to pay this off, we want to come clean with this. What can we do to settle? Okay, and then negotiate a price upon that where they're both comfortable with to pay them off.
And that would have less of effect and less of an adverse effect from the loan.
Absolutely. It just takes a lot of time and it takes patience on behalf of the borrower to do it upon themselves rather than paying someone to do it for them.
And again, just to be clear, we're not disparaging the loan debt consolidation industry. There are some, obviously like every industry, there are some very, very good people involved in that. We're talking about it strictly as how loan lenders will look at that one activity.
Correct.
Yeah, okay. So I just want to be clear, we're not condemning an industry that actually does do some very good work for some people. I'm going to ask you a couple more final questions. We'll try to wrap it up. From the loan processor standpoint, because I know you've dealt with every aspect and you've been intimately involved with all of it. What is the one thing that if a loan processor was sitting here today and she could turn to borrowers and say, this is the one thing or one pet peeve that they have, and she would like, please don't do this or do this, it will make my life easier. What do you think that would be?
It's basically the stuff that we went over today. Just be truthful with them. If they ask you for some documentation, try to provide it in a timely fashion. If you're not sure, what you feel comfortable talking to them about, go back to your loan officer, let them know that you had contact with the processor, discuss it, and consult them. The loan officer wants to help you get your home or refinance your home. So it's really having an open discussion with them, and they'll communicate with the processor as well too.
And it is one thing that I think you've been consistent with throughout this discussion is for borrowers to be honest. Treat the people on your loan side, the loan officer, the processor, very much like you would your attorney. If you don't tell them everything, first off, one thing, it's going to come out. The landmines are going to be found.
Yes.
And if they can't prepare for them, now it becomes more of an issue because somebody on the other side looks at it as an intentional attempt to not defraud, but non-disclosure. That it was an intent to not tell you, as opposed to, hey, listen, here's what I've got, and then you can deal with it. That's interesting. Is there anything else you'd like to tell borrowers? Any other piece of advice?
The one thing that I would tell borrowers is, when you're shopping for a home, speak with your realtor. Make sure that you do your research on realtors. Do your research on your loan officer. Make sure that you get pre-qualified. Make sure that the lender has reviewed your income, reviewed your assets, reviewed your credit. So when you're able to present your offer to the sellers, that you know that your loan is pretty much secured.
Excellent. And it's funny, I did just have that recently where the deal died. And one of the reasons it died was because the potential buyer, he didn't even have confidence in his own mortgage pre-qualification. And because he was so concerned about it, it started raising red flags on my side and on the seller side, and that transaction actually didn't go forward, and we had to move on to the next purchaser.
It does happen. I've seen it happen many times where sometimes a borrower will get a pre-qualification and something happens. Life happens. That can change it, whether they lose their job, there's an illness in the family, and they'll ultimately get denied for the loan. And the realtors will call and say, well, what happened? You gave a pre-approval. You pre-qualified them. Well, yes, we did, but something happened dramatically in their life that changed the whole transaction. And unfortunately, that's something beyond anyone's control.
Yeah, that certainly does happen. Unfortunately, life does happen for people. Anyway, Peter, I want to thank you so much for being here today. We're going to have your contact information has been popping up throughout our discussion, and will be again at the end. Again, it's Peter Browning from East Coast Capital. They're in Melville. They're a mortgage banker, and if you're a borrower looking for a loan, they're an excellent source to go to for both information and the actual loan itself. Again, my name is Joseph Beige. I'm a real estate attorney on Long Island. Thank you for listening in on this program. I hope you found the information helpful. Thank you.
Thanks for having me, Joe.